Over the last 24 hours, the crypto market has gone through another stress test, and importantly, it held. Bitcoin stabilized above a major psychological level after sharp volatility. Regulators reacted to a multi-billion-dollar exchange failure, and real-world crypto crime once again made global headlines. At the same time, long-term investors appear to be positioning quietly beneath the surface. In this video, we'll break down what actually matters, what doesn't, and what these developments tell us about where the market may be heading next. Let's start with price action. Bitcoin has stabilized above $70,000 following a volatile period that liquidated a large amount of leverage across the market. This level is important, not because of technical indicators alone, but because it represents sentiment. Above 70,000, market participants remain constructive. Below it, fear accelerates quickly. What's notable here is not just the price, but how Bitcoin is behaving. We are not seeing euphoric buying. We are not seeing runaway leverage. Instead, we are seeing consolidation. This is typically a healthier market structure than vertical expansion. Ethereum and the broader altcoin market followed a similar pattern. Sharp moves, forced liquidations, and then stabilization. In practical terms, this means excess risk was removed. Historically, markets that survive volatility without collapsing tend to rebuild strength, not immediately, but structurally. The most significant regulatory story in the last 24 hours comes out of South Korea. A local crypto exchange experienced a catastrophic operational failure that temporarily credited users with approximately $40 billion in assets that did not exist. While most of these funds were frozen or recovered, the damage was already done. South Korea's financial watchdog responded by calling for stricter crypto oversight, citing systemic risk and inadequate controls at centralized exchanges. This distinction matters. This was not a blockchain failure. It was not a smart contract exploit. It was not a decentralized finance issue. It was an internal accounting and operational failure. For investors, the implication is clear. Expect more stringent exchange controls, higher compliance standards, increased scrutiny on custody, reporting, and internal risk systems. Short-term, this creates regulatory uncertainty. Long-term, it strengthens market infrastructure, especially for capital that requires regulatory clarity before entering the space. Another headline dominating attention involves a crypto-linked kidnapping case in France. Authorities arrested 6 individuals connected to a ransom attempt involving cryptocurrency. These stories attract attention, but they require perspective. Crypto was not the cause of this crime. Crypto was simply the payment mechanism. Historically, criminals used cash, then wire transfers, now digital assets. However, optics matter. Cases like this accelerate government pressure, increase public scrutiny, and provide political justification for stricter oversight. From a market perspective, these stories tend to create short-term negative sentiment, but they rarely impact long-term adoption. Visibility is not the same as risk. In many cases, visibility is a sign that an asset class has become large enough to matter. While headlines focus on volatility and fear, positioning tells a different story. Several high-profile investors have publicly disclosed accumulation during recent uncertainty, including increased exposure to Bitcoin and large-cap digital assets. Whether one agrees with specific asset choices is secondary. The signal is behavior. Long-term capital does not chase momentum. It accumulates during uncertainty. On-chain data supports this narrative. Long-term holders are not distributing aggressively. Coins are moving off exchanges. Leverage across derivatives markets has declined. This combination typically suggests positioning rather than exit. Volatility forces weak hands out of the market, but it also creates opportunity for disciplined capital. So let's put this together. Over the last 24 hours, Bitcoin held a critical psychological level. Exchanges were exposed, not protocols. Regulatory pressure increased, and long-term investors quietly positioned. This is not market collapse behavior. This is a market in transition. Crypto is not ending. It is professionalizing. For investors, the takeaway is simple. Volatility is the cost of admission. Structure matters more than headlines, and patience continues to be rewarded. That's your crypto market update for the last 24 hours. If you want a deeper breakdown of where Bitcoin, Ethereum, or altcoins may be headed next, or a probability-based bull versus bear outlook, let me know. Stay sharp and manage risk accordingly.